The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks. If you have any questions, it's 877-927-6648. And I'm going to start the show today with a chart from one of our friends from down under in New Zealand. He's a hedge fund manager that does a lot of work with patterns and cycles and stuff. And he shared this with me that I think you'd be interested in. It takes us back to 1965 to 1975. So this is something that we've got to take keep an eye on, because this is the same pattern that we're seeing now 41 years later. And if you did the same thing and went back maybe another 84 years, you'd see the same thing that were happening in 1929. Whether this is the same or not, we don't know. It's always different. That's much we're sure of. It's never the same. But we do have that 1, 2, 3, 4, 5 expanding triangle that topped in January of 1973. This was the S&P. Now remember, the Nasdaq was only 6 months old at that time. It started in late 72. So the Nasdaq was basically, it was a little room in the Chicago Board of Trade building there on Jackson Boulevard that had very little. It was basically going to be an options market, which it ended up doing quite a bit. But anyway, that is what that's how it all started. But what's interesting about this chart, that because things repeat, and that's what we look for when we're doing pattern recognition, is we're watching this repetition. We think, because of what the Bradley model has told us, that we topped somewhere around December 31st, and then we came down for 6 weeks into February the 4th. That was not unexpected, because that was the Bradley date. It should be bouncing probably for the remainder of this week. It could turn at any time. We don't know. And maybe it doesn't turn at all. Maybe it continues to go higher. But believe me, folks, you've got two markets here. You've got the Nasdaq market, and you've got the New York Stock Exchange and the S&P, the real market of all stocks. So remember that when you're watching the Nasdaq, you're on steroids. So you have to remember, it's steroids up and steroids down. So, keep in mind that this is what's happening. What's interesting about this chart is that when it topped in 1973, and it was right near, I believe it was on July 28th, as I recall, and we went down and we had what we called was the October crash of 1974 of that year. That's even lower than what's on this chart here. And from there, the market went sideways, drifted sideways in a very narrow range, and did not make a new high until 1984. It was 12 years after that high was made that they made another high, and that was the one that we made in 1984. So remember that sometimes when these big patterns complete, that they can, really do a lot of damage. This one happened 41 years ago, and 40 is really something quite interesting. There's been interesting things on the internet about the similarities to what we have now and what we have to 1929. I've looked at the chart, and they do look a lot similar, but folks, it's really silly to look for a crash, because you look for downtrends. I mean, once we take out the the February 4th low, you don't have to worry about what the trend is. It's down. It is just, in my opinion, I don't think there's any question about that. Now, we've had some interesting moves in some other markets. The emerging market that we looked at last week made a Gartley down at the 786. The Nikkei Dow made a Gartley down at the 786. The Chinese market, the ETF for the Chinese market, FXI, also made a Gartley down at the 786 on that February 4th. So this bounce that we're having should last anywhere from 3 to 5 days, or 3 to 8 days, and 8 days would take us into Friday. And Friday we have a full moon, and we have Mercury going retrograde. And conventional astrologers tell us that when Mercury goes retrograde, people have a tendency, to make a lot of bad decisions. Well, welcome to the world of bad decisions, folks, because when you're trading, you're always making decisions, and not all of them are going to be good decisions. There's going to be a whole lot of bad ones, in the group, no matter what, because that's what trading is all about. It's about managing your risk, taking your losses, and moving on, to the next opportunity, that you have looking at. Now we had a request here, so we're going to honor this request. If I can get it to work, bear with me a second here. For some reason, it does not want to. There we go. Now we got it. It just takes Italian a little bit of time to get it working, and then it's okay. Okay, this is the gold market. We've been in this trading range now for a couple of weeks between 1280 and 1240. The difference is that silver is lagging badly once again, which is usually a very not a good thing for gold because they travel along together. We don't have any big increases coming in open interest or volume or anything like that, but it appears that at least we're able to unfortunately, that I'm unable to enlarge the chart that I have here because it's on my new computer. And let me see. Wait a minute. Oh, you know what? Son of a gun. Give me a pocket protector. I think I did it. Let's see if this works. I am going to be so happy if it works. Wow, this is going to make me. This will be a breakthrough in the world of technical stuff, folks. Okay, it worked. Great. So I'm able to make it. Anyway, you can see what's happening with the gold market. I wanted to show you the silver market the same way because we have the same situation occurring here in silver, and you'll be able to see that in just a second here. You'll see how silver is lagging. However, we are moving higher today. We broke above that little pendant that we had drawn for the newsletter this week. That once we cleared 2010 in the silver, that we had a chance to move a lot higher. We need to get above 2040, and then we'll have a really good chance for the market to break out to the upside in both gold and silver. We've been bullish in this for quite some time. I'd really wouldn't mind seeing a correction down to the 1220 to 1240 level one more time, but we hit 1250 so hard last week and then came back so quickly. It was a very, very strong indication that we were going to be in a place where we would most probably getting ready to have a move higher, and that's exactly what we've done so far. Okay, the next chart that I want to bring up is I want to show you where we are with the Bradley. We'll be able to blow that up here in just a second. Boy, this thing really does a good job. I've finally got my computers working. Oh, shut up, Larry. Anyway, this shows you where we are. We've had a really strong rally coming off the bottom. It's one of the strongest rallies like we've had off the October low, and that means that we have to really watch it very, very closely on what the retracements are going to be, on the way up, because there should be some resistance at around 16,000 in the Dow. I really don't think the market's going to roll over until Friday. I think we're going to be being pulled up into this because of the fact that all these things hit together. Bonds topped at the same time that the stocks were bottoming. The VIX index, went up and banged into that 20 area that Basil had been yelling and screaming about and could never close above it. And so that was another reason to tell us that there's no fear yet in the market, but it will come. It's just a question of when. And we're starting to see little cracks in the armor, but so far they're very, very small, and the Nasdaq erases them very quickly so that you never really see that the market is actually in much of a downtrend. There's over 60% of the stocks on the New York Stock Exchange are in downtrends, and they define downtrends by being below the 200-day moving average. So that's something that you might want to think about when you're looking at some of these things as we go through here. Now, I wanted to show you the Nasdaq because this was the one that we were talking about. If you'll give me 1 second here, I have to enlarge this so that we're able to see it as big as we possibly can on TFNN. But this is really, the chart on the Nasdaq is really what we do with price and time. As you can see, we've had these time cycles that were coming in on the highs, and that one came in on January 21st, and then we came down the exact same number of days in January. We were down for 2 weeks, and so we came down for 2 weeks, stopping exactly on February the 4th, which was a 61% retracement off of the November low. What that was telling you that, something strong was happening, and then the market just stayed there for a day, and then we have a very bearish jobs report, and the market just turned around and ran like crazy. That tells you that those reports, they don't mean as much as people think that they mean. They just literally, it's the cycles that are there, and that cycle turned, and it's it's going to be moving higher until we finish the next crest. And my guess is that should be somewhere. There's a whole lot of things to tell us that around 35.84 could be some type of resistance in the Nasdaq, but the S&P has not made a 61% retracement yet. And the New York Stock Exchange Index, which is the largest of them all, is just having its normal type rally. In other words, just the Nasdaq that is making this happen. It's like the Alex Rodriguez of stocks. And so you've got to keep in mind that when you're looking at the stock market, take your eyes off of the Nasdaq, because believe me, folks, that thing will really get you in trouble if you're not careful. And the reason for that is that it will tell you that the market's doing something when it's actually not doing it, because the Nasdaq is not the market. The market is the New York Stock Exchange Index and also the NYSE. The NYSE is the big one, of course, but that's the main one that you want to be watching. So I'm expecting to see a little bit more of a rally here for the rest of it. It won't be straight up, at least I don't think it will be. It'll probably be choppy, and then we'll come into this full moon and Mercury retrograde on Friday, and that's the time we'll be able to look at some of these price swings and see where we are as far as whether they're going to explode higher. There's a possibility we could get a blow-off top in the Nasdaq, 100 points higher from where it is right now. It wouldn't be unusual to see something like that. So we will we'll be watching that as we go through. We just had a crop report today for grains and for the wheat market. It turned out to be a little bit positive. I haven't been able to check corn yet, but I've been a little friendly to the wheat market, and it's had a pretty good rally here of 20-some cents earlier today, and that's telling us that we're getting ready to see some type of a move here. Maybe that'll start going in the spring that we've been waiting for, and we'll get a pullback. Okay, we got the Dow Jones down a little bit, and the Nasdaq is up, and gold's up about 10.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. With over 3 decades of trading experience, Andy Hecht brings a tremendous amount of knowledge and expertise to each weekly issue of his newsletter, the Technomental Commodity Report. The Technomental Commodity Report gives you Andy's unique technomental analysis of the commodities market, a combination of technicals and fundamental analysis which he has developed and perfected over his many years of trading. The Technomental Commodity Report is only $49 a month, and right now you can get a full month-long trial subscription while paying absolutely nothing. See for yourself the kind of weekly report Andy delivers to his subscribers every Thursday morning. You'll receive specific stock, ETF, and option trades based on Andy's analysis, so no futures account is required. For all the details and to start your month-long free trial to the Technomental Commodity Report, visit TFNN.com today.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks. I'm starting with the Dow Jones Transportation Index. As you can see, we made a 50% retracement on the low that we made from last October. That's when we were hitting the 61% retracement on the New York Stock Exchange Index. And so what's happening now is we have a potential for a head and shoulders pattern forming in the Dow Jones Transportation. And what you'd like to see is to see it be a little bit weaker than the rest of the market, which so far that is the case because it's still down on the day, with the other markets, rallying back to either break even or very, very close to it. So that's another thing that we should be watching for this week. This is just a very key week in cycle work and the astro work that we do. So Friday's the key day because of the full moon and the Mercury retrograde. Mercury retrograde means you really shouldn't do any contracts or anything like that, sign any deals, buy any cars, or buy anything of any major significance during the time that Mercury's retrograde. And it's retrograde 4 times a year, so don't make any big commitments like houses or cars, or things like that, during that time. That's what classical astrologers say, and I'm basically look at the numbers, so that part I don't understand. All I know is that when that's happened in the past, it's something to really pay attention to. I've had a request to take a look at Apple because we were looking at Apple as it reached the $500 level, and now we're rallying back. Today we're at the 50% level, and we're right near the gap. We're just filling the gap that we left down in the area when the news came out about their earnings. What's really amazing to me is when you look at the news today, you see on Bloomberg and CNBC about how the New York City pension funds are saying that they're telling Apple what to do with their money. In other words, to give some money back to the stockholders. And Carl Icahn says they should give another $50 billion buyback. Well, he's long the stock. What do you expect him to say? I mean, these people are they're being self-serving when they say this. So, keep an eye on it. But anyway, Apple is one of the stocks that's making the Nasdaq move pretty good, and it's right up into the 50% area. Right at the gap. That doesn't mean it can't go a lot higher, because the low that we made down there on late January, right 3 days after the report, was a 61% retracement of the low we made in September. So it's just a matter of looking at the numbers to see what's going to happen with it. But right now, Apple has been up 6 or 7 days in a row, right into the gap area. So we'll see what the indication will be for this, if it's going to have another move as far as going into a much big bull market. It has to get above. Apple must get above the the 565 area in order for it to return bullish, and then I would think that then it would have a pretty good chance of having a place to be bullish. Now I'm going to do the next one I want to put up here is the Russell, because this had been the leader of the pack up until the big break that we had, and you'll notice that it also made a 61% retracement off of the October lows, and you want to watch to see how the market is going to come into this rally high that we're expecting to come in sometime this week. So, and believe me, it could stop any time. Doesn't necessarily have to be on Friday. So this is one of those markets that all I can tell you, folks, with a great deal of certainty, and I mean certainty in the most humble way, that if we go below those lows that we made on February the 4th, that is going to be a very, very nasty sign. That will be following exactly what happened in 1973, right after the top. And it would also be nearly exactly what happened to the market in October. Actually, it was in late September of 1929, because the market topped on September 23rd of 1929 and had a big break. Then it had a nice little rally of about 61% for about 4 or 5 days. And then that's when the proverbial fertilizer hit the fan, because the market dropped from the high in the Dow at that time was 303, and it went down to 32. It dropped 92% of its value over the next 3 years, which led to the Great Depression. Okay, folks, we got the Dow still down a little bit, the Nasdaq up, and gold up about 10.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, Nasdaq, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and I posted a chart of the New York Stock Exchange Index. This is the index that I use to gauge what is really happening with the stock market because it's the biggest and the broadest of them all. And as you can see down at that February 4th date, we were making a 1.27 expansion from the low in December to the high in January to the low in February. That low at 97.30 was also our objective on the 618 from the October low. And so we have some really important things to gauge this on. The two things that are incredibly important about this chart, in my opinion as a technician, is, first of all, there are two gaps. We had a gap on Thursday, and then we had the gap on Friday. The gap on Friday occurred because this was 1 hour after we had the jobs report, and the market turned very strongly on the jobs report, and that moved it a lot higher. The second thing is the retracements are 618 and 786. That's what we're looking for to see if the market can reach that. We've got a call from California. Brent, are you there?
Yes, I am, Larry. How are you today?
I'm good. What can I do for you?
I'm calling about Apache APA.
That's
like...
Is that the company for T-Boone Pickens? I don't know if that's it or not. Is it?
It could
Maybe.
be. I know they have a big position like a natural gas, the Permian Basin they're involved in.
Oh, I see. Okay. Well, we'll take a look at it. We just completed a Gartley in that pattern too, just right at the 618, and we're having a really nice rally. Let me put this. Let me draw this in so you'll be able to see it when you go into Tiger TV. But it stopped spot on at the 61% retracement. So it looks like it's going to go up to at least the 85 level. That would be my guess.
Yeah, that's what it looked like. It also went down and closed that gap from back in August.
Yes, it certainly did, yes.
Okay, so it sounds like we'll see the same thing, which is that's what I want.
Well, the only thing you want to keep in mind, Brent, is you don't want this stock to go below 77 again.
No.
Because if you do that, then you've done some damage to the chart, because it stopped exactly where it should have at the 61% retracement, and if it breaks that, it's going to go all the way down. It'll drop another 10%, and there's no sense standing in front of that if it does that. So keep in mind, but you've had higher bottoms and higher tops since April, so it still is in an uptrend, and you bought it right. So just make sure it doesn't get below 77.
Yeah, I'll make that my stop. I haven't purchased it yet. I just wanted to get your opinion on it. So.
Okay. We'll be covering crude oil a little later, which will probably have something to do with Apache. But when you look at Apache oil as compared to crude oil, there's no comparison. I mean, they don't have any similarities as far as correlations at all. So I would think that that there's very little that's going on with Apache in the crude oil market. So it looks like you better trade it on its own merits and have not even look at the crude oil market.
Exactly. If you have a chance, could you go over natural gas? I know it's not commodity day, but
yes, it is. I watched that. I'll cover that next. As a matter of fact, stay with me here, and I just want to go over the because I've been our good friend Rich Anderson from Anderson Capital Management. I have never traded natural gas, but he told me to start watching it during this time of the weather because of the way that it moves. And frankly, if you'll give me a second here, I have to. It's had such huge moves that I had to expand the chart a little bit, so bear with me here. I'll put the chart in here into Tiger TV, and you can see from February 3rd, Brent, to February 5th, the market moved $11,000 straight up. And then from February the 5th down to the middle of February the 5th, in other words, in one day, it dropped $7,000. It had a $20,000 move from February 3rd to the middle of February 5th, then rallied to the 382 retracement, and then dropped another $7,000. So you're talking about $24,000 in swings in 1 week in natural gas. So it's not for the faint of heart.
Not at all.
That's for sure. And, it's had a huge, if you take a look at natural gas, on a long-term basis, you can see that I'll put this up here so you'll be able to see it from going back a long way, that it's had a tremendous move downside over the past 5 or 6 years, because it did top at $13 per cubic feet way back in 2008 and then went down to $2 a cubic foot. And so this rally that we had just shows that how wild. But as far as the volatility, I have never seen commodity move that much. In that this made silver look like melted butter compared to what natural gas was doing, and it was doing it, Brent, with just a few contracts. It was 1 and 2 and 3 contracts traded, because the platform that I use shows me the volume of the buying coming in, and there were not huge orders. Like in gold, it takes 500 or 300 contracts, to make gold move $8 or $10. Well, they were making this thing move, $1,000 on just a handful of contracts. So it's not for the faint of heart. I don't recommend it for anybody unless they're highly experienced in trading, because it's got a lot of volatility.
Absolutely. Well, thank you very much, Larry. You have a good day.
Yeah, thank you for calling in.
All right.
Okay, folks. Yeah, thank you. That was the natural gas, and it is really wild. It is something that you just, if you have someone that you don't like, recommend natural gas. It doesn't make any difference either long or short, because it's going to have a huge move. But to see moves like that is really amazing. And of course, you know what was happening is, first of all, we had the February contract was expiring, which means the open interest was dropping. And then as soon as that contract went off the board, it immediately dropped $7,000 a contract, and that took us, down to where we are now. And we're almost at the 61% retracement of the low we made from last December. That'll be around the $4 per cubic level, but we'll save that for another day. I want to mention a tiny bit about the crop report that came out today, because I'm hopefully we're going to have Rich Anderson on the show this Thursday. He should be back, and we have some ideas of what's happening with these grains. We're having a little bit of a rally in corn, wheat, and beans, which we've been expecting that, but what we're waiting for is to see how the market's going to take this rally, and then we'll watch the first retracement back to tell us that we have a much higher bottom, that we'll be able to buy some of these things, much like we were looking at last year in both corn and wheat. And of course, we got a little bit of the rally, and then of course, the market turned very, very bearish and went, far, far lower than most analysts, ever thought. So those are the things that we're following in the commodity markets. The gold market is doing, very little right now. It still hasn't broken out of this area of 1280 per ounce, was what we need to do to get it to close above there, and then the next stop would be 1320 per ounce. But we've had a very, very quiet rally, folks, over the last 10 weeks, and we bottomed at 1177 about 10 weeks ago, and I frankly thought gold would be a whole lot higher than where it is right now. And the fact that silver is lagging it badly gives me a little bit of caution about being long a whole lot of gold up in this area. So I prefer to buy it if it backs off a little bit, and that would be my suggestion to see if it is going to follow that path of least resistance. But boy, gold has had higher bottoms for the last 4 weeks, just like magic. I mean, each one of the bottoms has been right at a 786 or a 61% retracement. And it really turned out to be pretty nice. We've had a request here to take a look at copper, which we certainly can do. I believe that I have it right here. I think it's number 13. Let me see if I can find it. Where is 13? It should be right after 14. But the way I do things, not necessarily. Let me see. There's copper. Give me 1 second here, and I'll be able to blow it up with the help of our technical staff at TFNN, and you'll be able to see that we had a nice Gartley in copper, and it's had a pretty good rally coming off the bottom. We rallied about 7 cents, which is okay. It came off the 786, but it's like gold and silver. It has not done a great deal of any significance, only rallying. It's in fact, the rally that we've had in copper right now is exactly equal to the rally that we had in early January. It rallied 8 cents a pound, and that's where we are in copper right now. We've rallied 8 cents a pound, have not gone above it. So, it still is bullish, because we've had 3 higher bottoms now in copper, and it looks like we've got a chance that the market is holding here, and that could be a spot. But copper has been so bearish for so long that it needs to get above 1350 or 350 a pound or 360 a pound in order to to turn the trend to be bullish. That's when you have higher tops and higher bottoms, then you have an uptrend. Right now, you're just in a trading range in copper, and there's not a great deal to do when you're watching that. We had a request to take a look at the S&P 500 on the numbers that we were looking at, and you'll see that we also are looking at rallies to come into around the 618 or the 786 retracement level in the cash S&P, if it can do that. Now, we're not sure whether it's going to do that or not, but we'll be able to see that by the time we get it a little bit later on in the week. It's not going to be straight up, I don't think, except for possibly in the Nasdaq, because the Nasdaq is that thing's on steroids. It really does move. And not only that, folks, but it's starting to lose open interest, which is another thing that should be watched, because on this last big run-up that we had in the Nasdaq, there were no new players coming into the game. So when no new players come into the game, that leaves a big vacuum to the downside. It's like you're on a balloon ride and you run out of gas up there. That balloon becomes a parachute, and frankly, you don't want to be in that situation. We took a really nice balloon ride here around Thanksgiving. My daughter and my grandson were here, and we took a really nice balloon ride over the desert, and it was really fantastic. We could see the Colorado River, and it was really spectacular, and it's very quiet and peaceful up there, and you can hear the coyotes and all the other stuff that's going on. But boy, I'll tell you, once you get up about 5,000 feet, it gets a little bit leery because you don't want that thing to run out of gas, that's for sure. But it's a lot better than riding in a boat, that's all I can tell you, or sailing on a ship. Those things will not happen. Not to this old boy. I've learned my lesson in that. I won't allow that. Now, the next thing we want to talk about is one of oops, I did something wrong here. I've got to enlarge it. Give me a second. I'm getting the habit of enlarging these now. And I'm actually going to get a hang of this. I might even get myself 2 pocket protectors just to this is the VIX, and as you can see, we were looking at that area of $21, 20 to 21 that Basil had been talking about. The market went straight up, and what we've done is we pulled back down to the 61% retracement, and I believe we're going to hold this bottom that we made here. But as you can see, every time since last December, every time we've had one of these run-ups in the VIX index, we've had a pullback every single time. There's been 1, 2, 3, 4 of them, but it might be different this time. Maybe this will be the one that finally gets above 22, because once you get above 22, the move between 22 and I think 30 and 36 is going to be very, very quick. There's a lot of things that could make this thing do this, but as of yet, nothing has really happened. When bad news hits the market like we had on Friday, and the market didn't go down, it's certainly telling you that that it's not listening to the news. There's no question about that. That doesn't mean the news is not going to mean anything. It just means on that particular day, the news meant very, very little. That's the bottom line of what we're looking at is trying to interpret. Art Cashin from CNBC, he's a member of the the New York Stock Exchange. He had a very nice dissertation on this news on Friday, and he said he wasn't surprised. He said because the market was oversold, and he said the market was very bearish, but the market, once it wouldn't go down, the shorts started to cover, and he said it didn't take much of a rocket scientist to figure out that they'd been burned so many times being short that once they started to cover, it was a snowball effect, and that's what happens, and that's what we're into. We're into the 3rd or 4th day of that now, because the actual market bottomed on February 4th, which was that Tuesday. So that's the thing that we're watching very, very carefully. Okay, the next question. Someone had a question here. If you'll give me a second, I'll be able to bring it up, and that is about the Treasury bonds and Treasury notes. I wanted to give me a second here. I will make the chart a little bit bigger. That's actually doing pretty good. I can't believe this myself. I might start a class on how to teach people how to do technical things. Okay, we've completed, this is my opinion, we have completed a head and shoulders pattern here in the notes and the bonds. And this is going back for the last 7 months. You'll notice the distance between the shoulder and the head is exactly the same as the head to the shoulders. We've got the Dow down a little, the Nasdaq up. Be right back.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to the Gold Report, an $85 value, visit the front page of TFNN.com today.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different futures contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now you can receive a 2-week free trial to Taz Signal Box. For all the details and to find out how the Signal Box works, visit the front page of TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Okay, folks, we're back and we're talking about the head and shoulders pattern that we see in the Treasury bonds and Treasury notes. The next chart that I wanted to focus on here for our friends in Tiger TV is the chart of Treasury bonds. It's one of the most actively traded things in the world. It's far, far better than trading the E-mini S&P. I think it has about 6 times the volume that you have with the E-mini S&P, and of course the Nasdaq is a lot less than that, as is the Dow Jones E-mini. But this Treasury bond market was actually a thing of beauty with this report that came out Friday. The low that it made after the report was an exact 61% retracement of the low that we made back on January 23rd. The market then rallied almost exactly $2,000 to hit the exact 61% retracement of the high that we made back on February 4th when we were making 3 drive patterns where we had the ABCD butterfly extensions that were occurring to tell us that possibly this was going to be a bottom in the stock market because bonds were no longer a flight to quality on February 3rd, completing that particular pattern. However, the one thing that I would like to bring to your attention, and I don't want to harp on it too long because it's something that's from the old days, the past, and I want to make sure that we cover it because it's something that is very, very important because there's 2 things in the market that I think have potentials to be what we call black swans. One of them is the fact that we have this margin debt. Actually, there's 3 things. One is the margin debt that we have that is as high as it's ever been, which is very, very negative. And then I've also posted into the Tiger TV the chart for the Treasury bonds, showing the fact that bonds have been in a bull market since 1981. So that is 23 years they've been in a bull market, and they have completed that big bearish butterfly up there at the 155 level, and that means we're just in the beginning stages of a major bear market, which means interest rates will be going higher. I don't know what's going to happen to the Fed or what's going to cause it, but the charts are there. They don't change too often, and when you're looking at long-term charts like this, that's very, very important. So one is the margin debt. Two is the fact that we're looking at possible higher interest rates. And the third thing, which is the most ominous of all, is the fact that we have all of these patterns, as particularly these three-drive, this 5-point reverse wave, and a three-drive pattern happening on the long-term weekly and monthly charts in the Dow Jones and the S&P and the Nasdaq. Because the Nasdaq is pretty much making a double top from what it made back in March of 2000. But most of those stocks that were in the Nasdaq, you know, they went underwater. They used to be $100 a share. Some of them are on the pink sheets now, and some of them are not even on the pink sheet. So things do change, and they just bring in new stocks. That's all they do. If they don't like what's in there, they kick one out and bring in another one. You know, they don't want that exchange index to, drop too precipitously, so they bring in new stocks along the way. But this interest rate chart has some very, very bearish ramifications. So if you need to, make a commitment on a house, I would do it within the next year, because eventually rates are going to get above 5%, which is still fair for a mortgage. But right now they might drop a little bit more these next month or two, and that would be a good place to come in and utilize the interest rate on a longer term basis. So that's what the bonds look like. We've got the stock market is still. The Nasdaq is still up strongly for the day, but the rest of the market is a little underwater. Live every day in an attitude of gratitude, and may God bless.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
You're watching Tiger TV.